Terry Savage is the author of The Savage Number. She is also a nationally syndicated columnist for the Chicago Sun-Times. Terry, good thing, bad thing, doesn't matter that our markets were closed today.
Probably a good thing because, you know, as we're talking now, tonight, we will have another round of the European and Asian markets trading, and maybe they will become a little bit less panicked over our financial situation, a little more realistic, or maybe bargain hunters will step in. We'll see what the futures do overnight as well, but no question about it, the rest of the world is looking at America and saying, you folks have problems. We own dollars. We don't like the idea that you're cutting interest rates. We don't think it'll jumpstart your economy, and we're getting lower interest on the T-bills we buy. And then they're looking at the president's program to give rebate checks and say, you know, too little, too late, plus you'll have to borrow the money to do it. That's not good. Right. And so the rest of the world is saying, gee, if the U.S. economy can't grow and boom, what's going to happen to ours? And that's what's happening in the stock markets around the world.
So, Terry, I just heard somebody just last week, some Wall Street guru say, you know what, if you really want to protect your money, you should buy bonds. And I thought to myself, buy bonds? Where is that a good idea? Except unless you're a bond salesman.
Well, actually, temporarily, the Fed can try and push short-term interest rates down to get the market going again. But the rest of the world that buys our debt takes a look at America and says, wait a minute, you're creating more money to offset all the stuff that's draining out in these write-offs. You're borrowing more money in the future. We don't want to hold your debt. And then you know what we have to do to get them to lend us money and finance our deficits? We have to bribe them with higher interest rates. So longer term, I think interest rates could go higher, although temporarily an economic slowdown might bring them down a bit. It's a dangerous thing, though. There's risky as stocks in many ways.
Yeah, now the bonds, so the average person understands, if the towns can't get bonds, that means the bridges aren't going to be repaired or the sewage is going to go left unfixed, right?
Well, we're making a big leap here. First of all, the credit rating agencies are the ones that downgraded these mortgage bonds. That caused this thing to start. Many of these municipalities had money invested in some of these securities, the insurers as well. So there's an issue here not only with municipal bonds and the insurance on them, but the financial system is very interconnected. The hedge funds have all kinds of investments that are related to the ability to get credit. So in itself, the financial markets are very interrelated, and what shakes one passes through to the others. So there's two aspects. There's the technical market side of it, and then there's the U.S. economy side of it. If your economy's in a recession,
right,
well, what about the world? And finally, there's this issue of the world saying to us, America, get your house in order. You don't have a lot of room to manipulate here.
Terry, thank you very much. We'll watch the markets tomorrow and see what happens.